Good morning, Australia, and good evening, Baltimore. Uh, Thank you all for attending today. My name is Anthony Murphy, and I'm the CEO of Lucerne Investment Partners. Lucerne is an independent investment group, and at our core, we create bespoke investment solutions. And we do this by partnering our capital and our investors' capital with best-in-class independent investment specialists, and we do this both domestically and abroad. We tend to stick clear of traditional, often crowded investment vehicles, preferring to invest in proven managers that rely much less on favourable market conditions in order to perform. One opportunity we feel that many Australians are often underexposed to or underweight in their portfolios is venture capital. And to provide a deeper understanding of this space, we are thrilled and excited to be joined by Hunter Somerville today from Greenspring Associates, based out of Baltimore. Good morning, Hunter.
Morning. Thanks for having me.
My pleasure. Thank you for joining us. For those that are not familiar with Greenspring, Greenspring is a top-tier venture firm with a 20-year history with over US $10 billion in assets under management, and which Australia's Future Fund utilises as an external manager. Hunter is responsible for the sourcing and due diligence efforts on funds, as well as direct and secondary opportunities. He is also involved in the assessment of micro VC managers for the firm. Again, Hunter, thank you for joining us today. We'll break the session into two parts today for our audience. For the first part of today's session, we'll be discussing the venture landscape, initially providing an overview of the asset class and why it can provide such an effective way to gain exposure to the innovation economy that we're all talking about today. We'll then look at this from an Australian context with some of the key local players domestically. Then we'll look at how the venture capital has fared through the challenges of 2020 and also the opportunities that are presented as a result of the COVID-19 pandemic. In the second half of the session, we can respond to questions from the audience. So please submit any questions you have for Hunter along the way via the Q&A section at the bottom of your screen on Zoom. Hunter, thanks again for joining us. To get things started, as the venture market is so much smaller in Australia than the US, and you've had some experience here in Australia, can you provide an elevator pitch to the audience for the asset class for those that may be less familiar with it? So what is venture and what does it offer investors?
Yeah, no, happy to. And I've had the pleasure of getting to know the ecosystem in Australia from time spent assessing both funds and companies, and have come away quite impressed with what we're seeing in terms of company creation and general startup activity. I think there are areas where there could continue to be additional capital and expansion and growth, but very much like what we're seeing from an innovation economy standpoint in terms of what's happening in Australia. The US, though, remains the largest and most established venture market. Increasingly, Asia and China are giving it a run for its money. But the US, in terms of innovation economies, is the most built out and has benefited from a flywheel effect of tech companies that have grown to pretty significant scale that then go public or are acquired and spit off other talent that end up starting their own businesses and recreating that impact again and again. And in terms of why we like venture and why we've decided to dedicate our entire careers to it, it's a job growth engine for our economy and globally. This is how businesses get going and scale to significant workforces over time upon success. And it really has a material impact for the economy overall, despite being a small amount of the asset pie. So you could say venture does not require a ton of dollars, particularly at the early stage, to get a business going. And increasingly, that amount has decreased over time. But it does have a material impact overall in terms of job growth and general health of an economy. From an investment standpoint, venture provides you exposure to innovation and technology, as well as is important and impactful in life sciences. Those are the two areas where you see the most venture activity, life sciences and tech broadly defined. It's not as diversified from a subsector standpoint as other areas in private equity, but technology and healthcare are both two hugely important areas from an investment standpoint. And that's where VCs are most active. Venture at its core is about providing capital to exceptional founders and entrepreneurs, allowing them to get going, scale and build a business, add early revenue, early customers, begin to prove product market fit. And then in venture, companies raise subsequent rounds, oftentimes multiple rounds, in continuing to grow the business, prove things out. And upon success, 6 to 10 years later, a business will consider whether or not it would like to go public, whether it will pursue an M&A or a strategic sale, whether it may partner with private equity and buyout, or increasingly you have other mechanisms like SPACs, direct listings, et cetera, that companies can pursue from a liquidity standpoint. And so what venture provides is exposure to that trajectory and hyper growth, coming in at a very early stage, providing that capital, getting ownership in those businesses, and then eventual liquidity depending on what avenue you choose to take. And as an investor in that, you build a portfolio of multiple companies underneath to get that hyper growth.
Yeah, and just on that, so you mentioned obviously coming in early, obviously comes risk and elevated risk as a result of that. So how do you diversify away from that? How do you manage that risk?
Yeah, so Greenspring is a broad platform. We do a lot of different things and have different funds with different exposures. But at the earliest stage, if we're embarking on a strategy focused on early stage, diversification is incredibly important. You have to expect that a third of the companies within a portfolio will likely be written to zero. A bunch will be okay exits in the middle, 0.5 to maybe 3x. And then a bunch of the companies, if you're a good selector, will end up being hugely impactful and could be huge multiples on end of day capital. And so you don't want to come in without, adequate diversification and, not have enough opportunity to capture those home run outcomes at the end of the day. And so we build our portfolios with that kind of mindset and would encourage people that are, looking for venture exposure to be thoughtful around the required amount of diversification to be effective there.
Yeah, as you said before, a lot of those companies will tend to go to zero, but it's finding those, as we call them, the unicorns, the billion-dollar market caps that can make all the difference in that space, and your track record's proven in doing so. And in fact, there was a portfolio company I believe you've been involved with for some time that announced a sale this morning to Adobe, and that was Workfront. Did you have any comments to make on that most recent example?
Yeah, no, great real-time example, and super proud of the Workfront team and what they were able to accomplish. It's an investment that we've been involved with for a while now, and my partner John Averett was actually a board member for a period of time there, and just very impressed with what the business was able to do. They're based out of Utah, and have had an incredible team that's been able to execute year in and year out. And throughout the journey, there's been folks that have kept a close eye on it as a potential interesting addition to what they're doing. And Adobe decided to move in that direction and acquire the business this week. And for us, just very happy with the home for the team and what they'll be able to accomplish together. We think it's really a win-win for all parties involved.
Yeah, no, congrats on that result. And so why do you think venture is such an effective way to gain exposure to the innovation economy, say, versus other asset classes?
Yeah, I think in this environment, everyone's looking for ways to find growth, and it's not as intuitive or easy as it once was. And venture fundamentally is a way to get, rapidly growing businesses with nice margin profiles that are starting early with a lot of risk, but upon success are, potentially growing at 100% or more year over year. And so the ability to capture that growth, in disruptive, innovative companies that can accrete significantly in value year over year, offers you an interesting component to your portfolio that you probably won't be able to capture from other asset classes. And none of it is predicated really on leverage or financial engineering. Success ultimately depends on the ability for these companies to grow and succeed and be valued by either public market investors or acquirers. And so they need to be differentiated. They need to prove out their product offering. They need to scale, but the growth is very much there. And to the extent you can enter into these companies at a reasonable entry price with a nice ownership percentage, then you and the founder at the end of the day should be able to do quite well when realizations eventually occur. And so We think it's an important part for folks' portfolios. It doesn't need to be a huge percentage because for the reasons we described, there is risk to it, and it's more narrowly focused from a subsector standpoint. But it offers growth in a world right now where I think that's very challenging to find. And growth done the right way, actually through getting customers and scaling it and earning it.
I think also patient growth too. So, one thing we've always, I think, been guilty as investors is that word patience, and we can become quite impatient quite quickly with markets, and particularly with the information flow that we have thrown at us every day today. Sort of venture, I guess, in some respects, when an investor goes into this asset class, in some respects, they're sort of forced to be patient, which I actually think is a good thing. As you know, Buffett says, "What's your ideal holding period?" And he always says forever. And very few of us could stomach that. So do you just want to talk a little bit about that, how actually by being, in some respects, locked into that investment, that actually allows that capital to be patient and reflects those key attributes to venture that you mentioned before?
Yeah, no, it's important to be fully transparent around that. This is not a short-term asset class. So to the extent you want that growth and you want that upside, you need to be patient for sure. Businesses are going to grow from very meager beginnings, and hold periods could be, on the order of 6 to even, 12, 15 years. Because if something's working, you can continue to scale effectively on the private side and accrete in value, raise growth rounds, bring in crossover investors. There's no reason to rush too quickly to the public market, when you can continue to be effective on the private side. And so
that's a really important point, right? Because previously, and I've seen statistics around this, that companies now are actually preferring to remain private for longer and are creating a lot more value in the private space, whereas historically there was this greater rush to list and become sexy in the listing business, whereas now it's maybe the tables are turning completely. We're actually staying privates more than acceptable, and you've obviously would have seen that trend across your portfolios.
Yeah, that's totally been the case until probably the past 9 months, where you've seen an interesting dynamic on the public market side where pricing has been pretty interesting for private businesses to consider. You've seen the resurgence of SPACs and other ways to go public faster. And so it's a balancing act. Right now, you could make the case that going public may make more sense depending on where these companies were valued, most recently privately. But for the past 5 years or so, companies have been more patient about staying private longer. Now it really becomes a judgment call on whether the company feels like they're ready and whether they're getting the value that they think is appropriate above last round on the private side.
Yeah, great. Thank you.
And so to your point with investors, they need to recognize that this is going to be a longer term asset class. And when you invest in a venture fund, the only way that you're getting out of it is if you're selling it from a secondary standpoint. And depending on the asset quality or where it is in its life cycle, that will likely be done at some level of discount to NAV. So you have to be prepared to button down the hatches, stay engaged, stay involved, and wait out the growth. We think it's worth it at the end, but that's something to be very cognizant of.
So why do us Aussies tend to be underweight compared to the US when it comes to venture?
Yeah, I mean, you probably have a better answer to that than me. I think increasingly, in Australia, we've seen a really good resurgence in terms of startup activity and companies getting going. I think there have emerged a handful of very high quality early stage venture firms. We're backers of Blackbird as an example of one of them, and have spent time with a bunch of other groups that we think are very high quality too. And so my point of view is that, Australia is increasingly becoming more interested in venture because of the success they're seeing domestically. That being said, there are time periods where venture didn't work at all in Australia, and where entire generations of firms evaporated and disappeared, and a new class had to rise from the ashes and try again. And I think the new class is doing a great job at being effective there, but certainly I'm sure there are scars on behalf of investors that remember that time period where it wasn't an effective asset class and where there was a lot of money lost. And so it takes time to prove that things are different. And frankly, it takes realizations and capital return. So you can see a lot of unrealized markups and company appreciation and total value to paid in capital multiples that are compelling, but people aren't fully bought in until they see that translate into dollars returned. And
I think in the US,
we're on the cusp of that. In the US, you've seen that.
Yeah, and in the US as well, there's this sort of a greater level of acceptance of failure before you pick things up and move on. It's that sort of entrepreneurial spirit that the US has in leaps and bounds, and so I guess one can rise out of the ashes a lot faster as a result.
Yeah, that certainly is cultural in the US, and we're very accepting and embracing of failure, and that's a good thing in venture because you'll see a lot of it. But the belief and the ability to have huge success is the other end of the spectrum in the US that people can be excited about and know is possible, with hard work and grit. And so that's the ends of the spectrum. In Australia, my estimation though is that, with continued success in Australia, people get more comfortable with it and inevitably look at where the majority of the dollars deployed are in the asset class, which will point you to get exposure in the US and in turn get exposure in Asia more broadly defined.
And just on that, because obviously, our largest super fund being the Future Fund has been, I guess, a bit entrepreneurial and, a bit of a renegade in this space compared to other Australian investors and forward thinking. So you've worked with them for some period of time, and you mentioned Blackbird as well and some other groups in Australia. Can you share a little bit about your work with those organisations?
Yeah, I mean, we've had the pleasure of partnering with Future Fund for a number of years now, and they, as you described, are extremely thoughtful, are always thinking of ways to do each of the asset classes in an innovative way. And in venture, I think they've done a wonderful job at that, both domestically and internationally. Domestically, in partnership with us, we continue to assess interesting managers and come to decisions around who really is compelling on a world stage and who has done a great job in finding companies, sourcing them, growing them, finding follow-on investors internationally that can come in and be meaningful growth round investors, which I think continues to be a problem in Australia. And Blackbird for us is a great example of that. Internationally, they've also been very thoughtful at backing best in breed managers in the US, as well as backing best in breed companies, and have developed a very good program of investing, in co-investments with their most trusted relationships. And so have to give them all of the credit in terms of pushing the bounds of how to think about venture. And Greenspring has always had that mentality itself, because when we started as a firm in 2000, we decided to do fund direct and secondary all under one umbrella, all with the same team doing it. And so we felt like if you were doing all three areas, there would be J-curve mitigation effect that was a positive. You'd get to know the managers better. You'd build deeper relationships. You'd see them in action at the board level. And that flywheel effect of diligence and understanding how a manager works, would only be enhanced by being involved in all three categories.
So just on that manager selection, because look, it's something that we engulf ourselves in day to day at Lucerne, and something you guys do as well. What's your key criteria, particularly in the venture space, when you are considering managers, and probably more important when you're passing on managers or saying no to them? What do you really look for? What are your non-negotiables?
Yeah, and for us, we even do the hardest parts of venture, which is the small emerging manager segment, where you're making those assessments when it's people that have, very small track records, or have done it as angel investors, but haven't done it as, an independent firm, or were operators and on the side invested, or were a principal or a junior partner, but didn't do end-to-end from sourcing to board representation. And so all of that is extremely nuanced. And in the early innings of a fund's life, a lot of it looks good. If things all go bad quickly, then it's really not something to spend time on. But the more difficult thing is picking out among multiple funds that have 3x TVPIs and no DPI, where that's going to end up when all is said and done. Because if you're entering in at a seed stage, you should have write-ups in A and B, because inevitably companies will come in after you and see promise. Doesn't mean it's been proven out. Doesn't mean they've hit the promised land and nothing can go wrong. But those TVPIs aren't going to always translate to DPI at the end of the day that matches where it's currently carried.
And so, just on the terminology there, do you want to expand on that for our audience on DPIs and TVPIs?
Yeah, TVPI is total value to paid in capital. So it's basically looking at what the current NAV is of all of the underlying assets rolled up in an aggregate level. And NAV will increase when a company raises a subsequent round of capital. And so it'll be marked up because someone else came in and said it was more valuable than the person before it.
Or marked down sometimes.
Yeah, or marked down. Yeah. And so it's an independent assessment of value at that time, but it's not necessarily what someone would pay to buy it or what a public market investor would pay to own it. And
Sure.
So it's a fleeting value point in time that may or may not stay that way, if you fast forward 5 years from now. So when we assess funds, we take a very asset-driven point of view. And because we do so much direct investing, we look at the companies they're in, we understand who they compete against, what the enduring and projected value could look like. And that's, I think, a special sauce to our diligence. Like others, we care about their networks, how their sourcing is differentiated, how what they've done in their life before this leads them in a position where they should be seeing the most interesting companies in a subsector at a specific stage. And so we spend very, very much a good amount of time understanding those networks and why they're different and why they fit the backgrounds of the GPs. And then we do references with syndicate partners, other founders, as well as LPs or investors they may have worked with. And we try to triangulate a story around how these folks have really been helpful and additive. We don't want to invest in a passive capital provider. That's
Sure.
no good to anyone. There's nothing enduring about that. You need people that have been great partners to founders, and where the founders will come back to them when they raise another company, and where that serial entrepreneur effect is incredibly proven out.
Yeah, no, well said. Well said. 2020 has been an interesting year for markets. It's the first real dislocation we've seen since the global financial crisis, and I guess where 2020 was vastly different was the crash happened in a period of 3 weeks, whereas the GFC was death by 1,000 cuts over an 18-month period. Yet the market fell by similar levels over those separate time periods. How has that affected venture? And obviously there's been negative and positive, but my understanding is that on the back of dislocations, that's when venture can really thrive. And so what are you seeing in terms of themes around capital raise, deployed, liquidity? You mentioned before about the IPO and M&A market. How has 2020 shaped up for the VC space, and what do you think the landscape now looks like going forward as a result of what we've seen this year?
Yeah, no, happy to cover that. I mean, first and foremost, COVID has been disruptive and difficult, both at a personal and professional level for all of us. And so there's no discounting that. And, there are challenges that everyone faces on a day-to-day basis, and a lot of pain and suffering that people have had to endure across all different areas. And so for everyone's sake, we hope that, through venture or pharmaceutical companies with previous ties to venture, that we find vaccines that are effective and can make some real progress on ending this. As you look at the venture asset class, venture capital asset class specifically, during COVID, there have certainly been, both positives and negatives. If I had to weight it, I'd say it's been more positive than negative. A lot of models that are tech-driven have actually benefited because people have had to adapt and live their lives and their work in a different way than they've had before.
Look what we're doing right now.
Yeah, exactly. I mean, Zoom and other mediums for collaboration and for interaction have become paramount to maintain any level of normalcy. And so disruption breeds innovation, and innovation is what venture invests in. And so fundamentally, we are problem solvers, and we want to find ways to make it work, even in times that are difficult and tough like this. And so great founders will find ways to make this effective if it lasts longer, and provide technology to do so. And even if it doesn't, which I hope it doesn't last, much longer, people's behavior has changed as a result of this.
Absolutely.
E-commerce is supplanting brick and mortar for a lot of purchases that people would go to a store for. Now, whether it's groceries or something else, they've become comfortable with how to do that utilizing mobile or their phone having it delivered and, not having to go into a store to do everything. Or if you look at like telehealth and interacting with your doctor or physician to check in on an ailment, you don't want to be necessarily going to a doctor's office right now. You can hop on your phone, download an app like Teladoc, which we were invested in, and speak directly to your doctor and interact that way without ever having to leave the safety and comfort of your house. And so
12 months ago, that would be completely unthought of, though.
Yeah, exactly. Yeah. I mean, the amount of
almost
adoption
right?
in telehealth has been absolutely insane. I mean, I think a statistic I saw recently is 46% of people are using it versus 11% beforehand. So it was an incremental growth, and then it exploded. And similar on the e-commerce side. I mean, I think the level of adoption with e-commerce we've seen is almost the same as 8 years prior to the past 9 months. And so, yeah, this behavior will snap. I mean, life will snap back. Behavioral elements will not necessarily do so. Once people are doing something for a few months, they become used to it, and some stuff will return and some stuff will stay the same.
So telehealth and e-commerce are probably some of the biggest structural trends that you've seen as a result of the pandemic. Is there anything else that stands out from a VC space?
I mean, I don't want to be overly positive. There's areas of venture that are hurt too. Anything tied to tourism, travel, events, all of them have had to completely pivot or think about their business model differently, because without any of that happening, and these businesses are not profitable for the most part, they have to continue to raise money and go back for that next round. And you're not going to have a lot of venture investors sitting there feeling like, oh, I want to be in a bunch of travel businesses right now until there's more credibility on a viable vaccine taking us out of the difficulties we currently face. And so not all subsectors are doing well, but plenty are in venture and are finding ways to create innovation to deal with the disruption. And that's not even touching on healthcare, life sciences, and all of the good that's being done there, both specific to this application around COVID and every other disease that we haven't found a way to attack appropriately.
Are there any parts of the US in particular that I guess you think are sort of ahead of the race, and some that are sort of behind the pack in terms of what's been going on with the pandemic? Are there any particular parts of the country that are a greater focus for you?
I mean, the one thing I'd say on technology generally is the other thing that COVID has done is it has legitimized decentralized workforces. So instead of everyone having to be in an office in one place in some of the more obvious ecosystems for venture, increasingly the best companies are willing to take on talent wherever those people are located. And there are great people throughout the US in states that are not as obvious for tech talent. And there are great universities in the middle of the country and in less obvious places too. And so the ability to have people operate from where they're from and where they care about and where they characterize as home and be effective and be able to work for a great tech business, I think it's super exciting, super empowering, and will be great for the overall country. So
one doesn't have to move to San Fran anymore to be accepted as a tech guru.
Yeah. I mean, and that had already been happening with the rise of, New York and LA, but I think it's actually making other ecosystems that aren't as obvious viable. I mean, Austin seems to be taking off again. Yep. You're seeing parts of Colorado with that kind of impact, even areas in Arizona, the Pacific Northwest. I think there's a lot to be excited about more broadly in the US innovation-wise. And the VCs are realizing that they have to work for it and find it, and go the extra yard to win, which is good for founders.
No, absolutely. Let's just talk about the micro VC space, which is a key passion of yours, particularly, Hunter. What do you really like about VC is probably already seen as micro, but let's go one step further than that. What do you like about the micro VC area, and what are some of the prevalent themes that you're invested in today in that micro space?
Yeah, so micro we would define as sub 250 million in fund size, most typically 50 to 150 million. And they are using, they're doing an entry point of pre-seed, seed, post-seed, or small A. So the very beginning of a company's life cycle, generally no revenue or very early revenue. And those managers are, investing 500K to maybe 2 million to get a business going at the very beginning. Micro as a category didn't really exist until 10 years ago. So what you had before that,
basically, you're funding an idea and a concept. Yeah.
You're funding an idea. You're funding a great team and collection of people. The concept matters too, but ultimately the people and the talent and their backgrounds probably matters even more. But the micro category didn't exist 10 years ago. You had a bunch of, well-known groups that would wait for a company and that would generally see everything. It was a smaller universe. And then micro began as a category and went from 20 people to now 900. So if you look at the micro universe in venture, there's 800 to 900 groups, depending on who's counting. And these folks are coming in and writing $500K to $2 million check sizes, getting 10 to 15% ownership in a business, and are there from the very beginning, bridging it to an eventual A round. Why I like it is because a lot of these groups are newer, emerging, and really benefit from having a partner and care about the opinion and the perspective of their LPs and want to work very hands-on and collaboratively with them. And we can be impactful in helping them build an enduring franchise and a brand. Because the great brands out there in venture have done an incredible job at showing performance, persistence, and being able to have great companies come to them automatically and return and work with them. But for the micro side, that's their dream, is to become a great brand, even if they stay small or if they decide to scale and get bigger. And if we can be there and show them pattern recognition we've seen and point them effectively in that direction, then we're doing a great job at being an additive partner ourselves. And so I think that means a lot to what we stand for as a firm.
And that's a real point of difference. It's obviously resonated with us about Greenspring. So yes, at its core, there's a fund of funds model there where you're putting capital into VC funds, but then your other very strong focus is direct investment. And I think to that point there, it's about maybe the fund is initially seeding that idea, and as that idea is proven out and revenues generated, do you want to talk a little bit about how then Greenspring becomes directly involved in actually investing in those companies directly, and I guess picking the cream of the crop to take to that next stage? I think it's just a very powerful additive in your model.
Yeah, no, thank you for saying that. And what we take the most pride in is that we have built a platform that we think is enduring and synergistic. We have a number of different strategies that do different parts of venture, whether it be our fund of funds or what we do on the direct or secondary side. We touched on micro. We also have an impact fund of funds and a diverse manager fund of funds as well, where we're also backing emerging groups that exhibit diversity at the team level. And so for us, being able to have a platform that reinforces each of the different strategies and makes us better, we think is a real barrier to entry versus other people doing what we do. So that gets us excited. And to your point, our founder, Ashton Newhall, and still my current partner, had the foresight when he started Greenspring to include fund direct and secondary all at the very beginning. And so as a result of that, we are one of the earliest investors in doing what you would call co-investment in venture. And people have been very active in doing co-investing in buyout, but in venture, that really only started to pick up like 6 or 7 years ago. We've been doing it for 20. And whereas we started as doing small co-invest, now what we look to do is, as you described, lead price and structure rounds. Yep. And so we back the best early stage funds, and then we look to invest in the best companies once they get to C or D rounds, where we would be viewed as a great partner to the existing board and syndicate and to the founders, where we can come in, not upset board chemistry, work collaboratively with them, find customers, help with recruitment, and be a synergistic partner to all of the constituents that are already involved. And for the reasons I described in diligence, that allows us to see the managers, in their element, see how they're additive at the board level, and all of it sort of ties together nicely from a fund direct and secondary standpoint.
Yeah, it's a very powerful model. Unfortunately, we've been one of those ones. I've only adapted it for the last 5 to 6 years in Australia, but where we've invested capital in funds and they've had a transaction, and that transaction could be circa, say, 20 million and the fund will take 10, and then they offer the other 10 to the balance of their investors, and that's when we've participated, and it's been a great value add on the investment piece, and something that definitely attracted us to your model. And as you said, you've been finessing it for a number of years now, which is great. Just there's a few questions that have come through from viewers, and just a reminder for anyone that does have questions, feel free to log them and we'll ask them of Hunter, and if we run out of time, we'll be sure to respond as well. So one in particular is obviously Asia. You have offices in the US, of course, London, but also Beijing, and Asia is an important part of the portfolio. It's important from a geographical perspective to Australia. China's a big trading partner for us. We obviously do a lot in Southeast Asia and Japan as well. Just want to talk a little bit about your presence in Asia, the trends that you've seen in that space. Obviously, because it is outside your own direct backyard, some of the challenges and opportunities you've seen as a result of investing in VC in Asia.
Yeah, happy to. So we've been fortunate to be investors in Asia for about 15 years. So it's not something we've embarked upon recently. And we began building relationships around 2005. And most of those were, funds that were part of a broader global platform with a dedicated US team. And then they added partners in Asia specifically under that same fund, or added a separate fund, and those groups started staffing up. But we got to know folks that were tied to people we trusted, and we worked with them in that capacity. And over time, many of them spun out, started their own firms, or effectively started their own firms, but kept it under the same brand they started with. And so anytime we work with anyone on the fund side, it's not like a 3 to 6 month process of getting to know them. It's like multi-year, where we're building trust. We're seeing if it's a good mutual fit, a good collaborative partnership. And that's very much been the way that we've built our relationships in Asia. It's been through that way, or spin outs from managers we're already working with, where someone left to do their own thing. We're not going to willy-nilly enter into a situation with a group that we've just gotten to know. We're just not that easily seduced. And so the trust factor is what's sort of at the core of anyone we would do there. And we've been investors in China for 15 years. We've been investors in India for a decent period of time. We've been active with our friends at Altos in South Korea. And increasingly over the past 2 years, we've been spending a lot more time understanding the dynamics in Southeast Asia, which we think is a very interesting regional ecosystem as well. And if you look at dollars deployed in venture, 30% of them globally go to Asia. And so not participating in that segment is almost criminal, because it's such a big part of the pie. Just like US, continues to be very meaningful and bigger than the 30%, giving up on Asia and not getting exposure there is missing out on its own ecosystems that are important and can stand on their own right in the venture asset class.
So what about Europe then?
Yeah, in Europe, we've been investors for a while too, probably about the same time frame as when we started investing in Asia, actually a few years before even that. In Europe, it's an interesting market. A lot of the firms that I think are the most interesting are smaller, are sized between
moving as your US and Asian-based economies, though, I'd say. Would that be fair to say?
Europe has become much more interesting over the past few years than what we would have said 10 to 15 years ago. Companies are scaling more effectively across countries. They're thinking about their end markets in the US or Asia or somewhere else, and not waiting until like late stages to pursue that. And so Europe, we are increasingly putting attention and time around. But to my point, I think a lot of the interesting groups are still small there. And you have some firms at Series A that just have a huge advantage, some of whom we're in. But the seed groups and the smaller side, I think, is where you're going to see the most interesting opportunities in Europe arising from.
Okay, thank you. A question from one of the audience members is, what is one current thematic you are seeing in portfolio companies that you believe public market investors are underappreciating?
I think public market investors are appreciating probably innovation and technology at an appropriate to high level at this point. And so, you have time periods where companies will go out and where the private rounds were way too high, and then they have to go public and they get a cold dose of reality. In the time period we find ourselves now, I would say, for the most part, tech businesses are still in short supply on the public side, and people are seeing these rapid growers and are excited about owning them. And that's why crossover investors have dipped down and have private public funds in order to get that exposure before they go out. And so I think they realize to get a full arbitrage, if they can do something in late stage private to couple their hold on the public side, it can even provide jet fuel in terms of appreciation and more near-term growth. And so, I think the public side is valuing these businesses appropriately at this point. From our standpoint, I wouldn't say that they're being overly harsh on a multiple basis. Life sciences and healthcare is different. For a lot of those businesses, an IPO is a financing event more than a value appreciation occurrence, and so they would prefer to go public earlier in their clinical life cycle. And you may not see that pop within the first year, but that's fine. They use it in a different way than the tech businesses that would go out.
Mm-hmm. Okay, thank you. Another question here. For typical businesses you review to invest in, how long have they been established by their owners on average? Is it 1, 3, 5 years? When we spoke before about there being an idea, but does there have to be some sort of track record? What does a typical investment look like, and from that track record?
Yeah, so for our funds, the business could be in existence for like a year, or it could be at the very beginning. Our funds are early stage investors, and so the seed groups that would be coming in are probably coming in right after a friends and family round or money that the founder had to start the business. And so it's very much at the inception of these companies. Where we invest directly, we are looking for businesses that are further along, that have gotten to a certain revenue scale. So they could be in existence for, 5 to 6 years before they'd hit our stage of comfort for direct investment.
Right. Okay. That's longer than I actually thought. 5 to 6 years. It's quite phenomenal. Yeah. What investment theme or themes do you think have the most mileage over the next 2 to 3 years?
Yeah, in venture, we don't ever think in terms of 2 to 3 year periods. So, for our funds, we are investing behind the best managers that'll look around corners and find disruptive new categories that people haven't appreciated or even thought of before. And some of it may feel crazy or sound nuts when they started doing it. Areas of aerospace that some of our partners invested in 6 to 8 years ago, we thought were absolutely crazy. Now we are direct investors in one of those with Rocket Lab out of New Zealand, which we are huge fans of and very proud to be involved with. But at the very beginning in seed and Series A, some of those ideas just seem absolutely nuts. But that's what great early stage investors do. They understand what's nuts and what's nuts but has potential. And so I think what they're looking at, we haven't even appreciated yet. For Greenspring on the direct side, we're doing businesses once a category is more established. So we've been very active in software as a service, next generation models around fintech, insurance tech. You've seen a ton of innovation around, areas of e-commerce, consumer goods that we think are compelling and can do well even in this environment. Runs the gambit. I've done some interesting healthcare services deals, some healthcare IT deals, but we're not going to do the bleeding edge categories until the category itself is established. That's what we leave to the folks on the fund side that are smarter than we are.
No, fair enough. Any investments in blockchain?
We've done very little there. We have a little bit of exposure through our funds, but we have not done anything directly. And there's only a handful of companies that have gotten to a scale and a stage standpoint with round sizes that we would consider that we would even think would fit our parameters. But some of our funds, and you have some great dedicated groups doing blockchain, in their own right. You've even started to see fund of funds that have sprouted up to do blockchain. It just hasn't been an area that we've overemphasized. I think we're interested in the category and what it stands for. Equity investments in blockchain applied to other subsectors, we think is probably the most compelling. And
Sure.
we as investors aren't really paid to invest in the currencies. I think people can make that determination for their own portfolios. I think there's interesting elements to that, but we're not going to invest in crypto securities because that's not what we do.
Sure, no, fair enough and understandable. When you take in direct ownership in some of these companies, the placements that you lead, what's your typical level of ownership? So do you have a minimum requirement if you're going to do a direct investment, and do you have a maximum as well? How's that look previously?
No, and no. We don't have any rules around ownership. We like our funds to have rules around ownership because we think ownership matters the most at an early stage. So when you're coming into a company in seed or Series A, it's important that you're getting 10 to 20% ownership in a company. And you're going to have to do reserve management and try to find a way to maintain that after a company raises 5 to 6 more rounds, some of which you can participate in, some of which you can't. At our stage of entry point directly, we're trying to get into the best companies, full stop. So what's important to us is that founders view us as a valuable partner and that they see a need to let us in at that point in time. And so we don't come in with any kind of dogmatic requirement around what we need to own in a business at the stage where we would become involved.
Okay, no, thank you. So just on some of the fund, I guess, demographics itself, if one is choosing to invest with Greenspring, so minimum ticket size through a sort of partnership program is 15 million. Is that correct?
We have investors of all different sizes.
Okay.
So we believe in democratizing access to alternative assets. Right. And so we don't have a rigid point of view around investor size or feeling like, one category is better than others. We try to purposefully diversify our LP base by category and geography.
Okay, great. Okay, that's fantastic. How exposed to fintech are you?
We've been active in fintech on the direct side and have done a number of different models, like I said, in insurtech and in other areas. And so we're excited about it. I think you're beginning to see realization activity and people looking to own these businesses or, public market receptivity to these businesses going out. I think all of that was sort of in the TBD category, but we're beginning to see that rewarded. So we like fintech as an area and have done a decent amount there. I mean, there are models we're worried about, and when it's a model that's overly cash burn, focused, and where they're plowing through a lot of money quickly in order to generate that growth without any kind of view towards profitability in a reasonable period of time, that model scares us. But fintech doesn't have to be done that way. I think people assume that one or two categories in fintech define the whole bucket.
Yeah, fair enough. So just with what's obviously happened with COVID, this is the last question we have at the moment from the audience, with COVID in the year that we've experienced, how's that affected, the VC pipeline and, people, investors as a whole, view of putting capital into the space, and we have to do meetings via Zoom these days and whatnot. So has VC benefited from the disruptions we've had in the economy in terms of investor flow into the space, you feel, on a landscape basis?
Yeah, fundraising has been very healthy in the venture category, but it has been mostly around established groups. So the people that have done this for a while, have seen a bunch of cycles, have established a pretty built out track record, have tremendous amount of interest in what they're doing, and have been able to raise their early stage funds in record time and have been able to raise much larger growth funds also in record time. Emerging managers in that micro category have a much more difficult time in getting funds going. And I think people have had a flight towards perceived safety and quality. I continue to think a balanced portfolio of both is important. But right now, much easier to raise if you're an established group than an emerging one. And people want venture exposure more than they have historically. And you're seeing people that haven't played in the asset class become more interested and more involved. Although I think a lot of their capital is more biased towards the later stages because that's where you're able to get access more readily.
Thank you. This is a good question. Is there any personality type you like to see in a manager of an investee fund?
No, I mean, there's such a range. I mean, you have introverts that are really tough interfaces that, I may be sitting with them and wanting to have a conversation and it's like pulling teeth. And then you have others that, could be completely extroverted, very gregarious. It doesn't really matter how they interact with the LPs. It matters how they interact with the founders, and that their personality, expertise, knowledge that they're sharing resonates with the people that they're serving. And, founders all have different personalities, particularly in venture where there's highly technical elements. And so just because someone may seem weirder to mainstream doesn't mean they can't be an effective partner or founder.
Thanks. Completely non-content related, but for one of the audience members, I grew up in the Owings Mills area. Great to see hometown success at the Greenspring level.
That is impressive. People don't normally know where Baltimore is, but Owings Mills is, one in a million. So appreciate that.
There you go. I think that's it from questions. I'll just double check that from, there might be one more here. Yeah, roughly, do you have a sort of target percentage when investing in Asia or the micro funds, and what percentage is invested in direct company investments?
Yeah, I mean, with Asia, if you look across the platform, we've generally sized it at like 15%. So we're arguably underweight versus, the broader pie breakdown that I described. But we're excited about it, and we're looking for ways to expand exposure there.
It's still quite a meaningful allocation, though, in the broad
sense. Yeah. And it's dependent on the specific fund I'm talking about, but just to give a rough approximation.
Sure. And what do you see as the benefits of combining both the fund of funds and the directs?
They're just complementary to each other. The funds invest at the earliest stage. They obviously have more upside upon success, but they take longer. The directs have a mitigated hold period because we're coming in the middle, and we can drive capital back from the direct investments before the underlying companies and the funds pay off. And so it smooths out the cash flow profile for an investor. It drives capital back faster. It appreciates faster through the directs, and then the funds pay off later. So just from the standpoint of an investor, it has that benefit. And as I described, we think the benefits in terms of assessment and partnership are even more meaningful in terms of how we get to know and work with the GPs we back.
Okay, thank you. And this is our final question. What do you see as the common capability shortfalls in managers in investee funds?
Their ability to work as a team.
Yeah.
Nothing sinks any organization like infighting or incompatible personalities or a lack of appreciation for your teammates. I mean, the reason I think Greenspring is so effective is how we built the team. We're 125 people, and we've had incredible consistency at the senior level. And we actually really enjoy and like each other and are happy to be direct and share a point of view. And that's what you need at any fund or any company, is the ability to exchange views with people that are different than you and do it respectfully, but get your point across and tap into the knowledge of all the diverse constituents that make up a great organization. And if you can't do that, and you don't have tough skin, and you can't take that constructive criticism, it's going to build a toxic culture.
Yeah, no, absolutely, and well said. So keeping within the hour, in the interest of times, we might conclude today's session. So on behalf of Lucerne and the audience, and all investors that have dialed in, we'd just like to thank you, Hunter, for giving up your time today, or this evening, as I should say, and for sharing your valuable insights. Look, it's been really interesting. It's a very interesting asset class, as I said before, and one that I don't think we appreciate enough in Australia. So it's been a privilege to hear from you with someone who's got such expertise in the VC space. Thank you to everyone that has tuned in today. We'll also be sending out a recording of today's presentation and a transcript shortly, so feel free to contact us should you have any further questions today about today's presentation or on Greenspring themselves. So thanks again. Have a good day or good evening if you're in Baltimore.
Thanks so much. Thank you for having me. It was a lot of fun.
All the best.